Improving Alpha Innovation in Investing, ESG and Technology with Michael Oliver Weinberg, in partnership with Vidrio Financial, is being sponsored by Alternatives Watch, providing a 360-degree view of investor mandate activity across alternative investments. TheFundMarketer.com, a comprehensive directory of products, services, and information for asset management, sales, and marketing professionals. And PEVC Tech, a community for family offices, private equity funds, lenders, and VCs using AI and analytics to generate alpha. Vidrio Financial is a premier data management provider, shouldering the responsibility for your data from collection to extraction, transformation, and enrichment. Vidrio monitors over 2,000 diverse funds, processing millions of data points each month. Discover how Vidrio empowers your institutional portfolio data by combining advanced AI and human expertise to yield comprehensive analytics on performance, cash flow, risk, valuation, and more. All delivered seamlessly through Vidrio's Data Management Hub. Save your investment team valuable operational time, providing actionable insights like never before. Explore more at vidrio.com.
Hi, this is Michael Oliver Weinberg. We would like to welcome everyone to the Improving Alpha Innovation in Investing, ESG, and Technology podcast series. Today, Catherine Ulozas, Chief Investment Officer of Drexel University's Endowment, will be our guest. So listeners have a high-level sense of our roadmap. We'll start with some background, then discuss innovation in investing, ESG, and technology. Investors and business leaders should be able to extract a great deal of value from Kathy's insight. On that note, welcome, Cathy.
Thank you, Michael.
Let's start with your background.
Well, I actually started my career at Aetna Life and Casualty in the finance side, in the corporate finance side, and ultimately moved over to the bond group and was an analyst and then a mortgage-backed trader at Aetna Life and Casualty. And I spent most of my early years in different insurance companies working on the bond desks, and ultimately moved from that to the Arizona State Pension, where I was in charge of the fixed income part of the portfolio for the pension fund. I ultimately moved to ING Direct. If you recall, ING Direct was actually the first direct bank. We like to think of ourselves then as actually the first fintech. We convinced people to give us money over the phone and online without having a branch, without having a checking account. We were savings account driven. And we were able to convince millions of people to join in on a low-cost banking product. I think that was an amazing opportunity for me. I worked there on the fixed income desk. It was an amazing opportunity because as a federal savings bank, we had to have 2/3 of the portfolio in home-related mortgage products. We couldn't create those mortgages directly very quickly. So we had a very large securities book of mortgage-backed securities, which the desk ran something like $63 billion worth of mortgage-backed securities. It was an amazing opportunity. The financial crisis came. We were very lucky and possibly skilled in the fact that we had very super senior types of securities on our books. And while things slowed down, we didn't really have much breakage within the portfolio at all. So we survived the crisis pretty well. But during that time, I was given an opportunity to actually move from the desk and work on process improvement. It was a huge change. The CEO said, "Would you do this for me?" I thought it was a project. It turned out to be a job in which we were doing process improvement, Six Sigma-based process improvement throughout the bank. I think in those 2 years, I learned more than I've ever learned. And I learned a lot about banking. I learned a lot about being able to discern opportunity sets, to be able to use really strong analytics to help find the right solutions and improve. Over the 2 years, we saved the bank $17 million, and only one person actually lost their job in this, and that was because we literally stumbled upon fraud. And and that was all resolved. But moving from that was an amazing experience, and being able to interact and convince people that we could make these changes within our own operating system for the betterment of our customers, for the betterment of our bottom line, was an amazing opportunity. From that, I did come back to the investment side and apply for a job at Drexel University for the chief investment officer position. And astoundingly, I was given that role. It was hard to believe that someone with primarily a fixed income background and just having left 2 years of process improvement would end up in a multi-asset portfolio. And I think a lot of that had to do with the chairman of the investment committee at the time was a banker and appreciated my approach to safety first. And having come out of the crisis, Drexel's portfolio hadn't held up that well. And I think that having someone come in and talk about protecting assets was something very important for them. So I came over to Drexel, and one of my colleagues from ING Direct, who was on the desk with me, followed a month after. And Matt D'Angelo and I have been working on the portfolio ever since. We've expanded the office. We've moved from about $650 million to over $1 billion. And I think we are in a great position for Drexel moving forward.
Ah, that's great. Super interesting. And what's the objective there? What are you trying to achieve in terms of maybe from a return perspective?
For long term, we base our view on how we want to structure the portfolio on a risk return basis. So we're not taking that typical consultant driven asset allocation bucketing type of mentality. Instead, we are looking at what is the risk that we are willing to take for the return that we are trying to achieve long term on the assets in the portfolio. So we really base how we structure the portfolio with that in mind. So for us, we are looking for the typical levels that endowments look for in terms of return for the long term, but we are very risk oriented in how we approach adding, subtracting, and moving our portfolio around. In terms of that, we're not day traders. We are there for the long term, but everything we do is within a risk context.
Presumably you, as an endowment, you're paying out high 4% sort of, and then trying to earn a return in excess of inflation and a real return in excess of that. Yes,
correct. One of the most difficult parts right now is that we have been planning for a 4.75 type of spend rate in these last years, particularly coming out of the pandemic. The need for the endowment to provide more to the university has been prominent. And so we've had to increase our spend rate to 6% and even 7%. That's very difficult to adjust and account for. We expect this to be short-term in nature and ultimately be able to be moving back to the level of 4.75 that we want. These are very difficult times as we have been facing problems in higher ed. A lot of unexpected issues have come up that affect the institution. I think that we continue to view this in a very conservative light. We try to do everything we can to protect our corpus, build our ultimate long-term returns. It's a difficult time right now. Specifically for Drexel, we've had some challenges, though I think we have done a really good job at handling them. One of them that we faced not too long ago was that one of the hospitals that we were affiliated with and where our medical school had lots of residencies and our doctor's practice, etc., is St. Children's Hospital, St. Christopher's Children's Hospital in Philadelphia. This hospital serves the underserved. It doesn't make a lot of money. It was initially owned by Tenet, and we had an affiliation with Tenet for St. Chris as well as Hahnemann Hospital. Hahnemann Hospital did close. St. Chris stayed open during the pandemic, and we actually, with Tower Health, ended up buying it. Tenet had sold it to private equity. The deal was done in such a way in which the private equity firm, there were two of them, one bought the operations, one bought the property, you know how the story ends, right? The operations don't do well. They own the, they were looking for the property, but ultimately for St. Chris, we bought the hospital with Tower Health. Drexel and Tower Health formed a partnership and bought the hospital. And Tower runs the hospital, but obviously we were there. But to provide the funds to be able to do that, the endowment did actually invest in St. Chris and provide a $40 million line of credit to get it up and running appropriately under the new structure. We were ultimately paid back via a bond issuance that Drexel did during the pandemic at very low interest rates. So we were very happy to have been repaid. But that is one of the activities that we've been able to do within the endowment to help support the long-term mission of the university. Our medical school is critical. Saving St. Chris was a critical mission for us. So we were very happy to be able to provide that, find a structure that worked, and not typically something an endowment is making an investment in, but this is what we were able to do.
Makes sense. And to your earlier point, yeah, I mean, aside from inflation, obviously the costs of higher education, in my understanding, have become bloated partially because of administration. The ratio of administration to students and teaching faculty has become immense.
Yes, I will say this is not necessarily all of my area of expertise here. I will say that I think that there are lots of need for lots of reporting, particularly when you're a university like Drexel, where we have 13 colleges and schools, and we have a medical school, and we have a lot of different needs. And when I think one thing that I've talked particularly with the department and with the woman who runs the department for our insurance needs right now, how many different insurance policy Drexel has for so many different reasons, and the costs that have just skyrocketed on this front. That's just one example of what we're all facing here. I think that Drexel tries to run as lean and mean on the administrative side as we can. I think there's always room for improvement. That will be my process improvement background that comes through here. But I think that we look at how the effects of costs that we've seen rise so dramatically in so many areas is a direct impact. And it's very difficult to find ways to get revenue to our revenue streams are a bit limited, right, from tuition, et cetera. So I think, it is a very difficult time. And I think Drexel's trying to approach it as well as we can. And I think good progress is being made, and that we are, as a university, together trying to solve for the future and the needs of our students going forward.
Yeah, it makes sense. So from an investment perspective, how are you innovating?
Well, one of the first things that we've done is sort of innovate the office first. I think we have now moved from relying on outside sources and bringing a lot more of our needs in-house, bringing in risk analytics, CRM systems, expanding staff in such a way that accommodates our needs both operationally and analytically. So we have been utilizing more technology, bringing that into the office directly. We like to do the analysis. We like to put in the factors that we want to assess within the process. We're not leaving this to a model driven by someone else.
So that ties into the other topic, which was innovation in technology. What about ESG? What is your and/or Drexel stance on ESG? I mean, I think governance is typically less controversial, as it's hard to see anyone who's not a proponent of good governance. But although I guess even there with Elon Musk and Delaware and California versus Texas, there's some and Delaware. There's some controversy, but I don't imagine governance is terribly controversial. Where, and I'm not necessarily looking for controversy, but where do you and Drexel stand on the E and the S, the environment and the social?
First of all, I think that the G drives a lot of the E and the S, right? There are rules, there are laws around environment, there's rules and law around employment, that we have seen from the governance side. And I think when you have strong governance, a lot of those other factors fall into place. For us, we don't have specific targets that we're trying to hit. What we have done, and I think we were actually early to the party, is we were asking a lot of these questions of our managers. We were saying there are risks here in the environment. There are risks here on the social side. How are you addressing them? And we were able to assess our managers' responses there. So we were asking these questions actually before it was popular. And so we've been looking in that for a long time and has been part of our due diligence for a long time. And when then you run analytics against that, we have done very well. But this was part of the DNA to begin with.
Where are you seeing the most interesting opportunities from an investment perspective now?
I think there's two places that we see positive opportunity. I think that a lot of that happens to be on the real asset side. That's a disparate group of assets that are available there. I think there's a lot of potential to take a look at. I particularly lean more towards debt on a lot of those types of assets. The other area that we are interested in is EM in emerging markets, as we look to see what the development, the opportunity sets are there. Again, I think when we look to evaluate if that's in equity or in debt, we're possibly leaning right now more towards the debt side. Traditionally, in the past, you've seen similar return levels between EM debt and EM equity, debt having less volatility to it over time. Of course, you do have to account for currency issues as well and political risk. But I do think that as we see markets emerging here, there are good opportunities for us to take a look at.
And within EM debt, for example, how do you pursue that? Is that something you use one or multiple external managers for? You have a team doing it internally? Give us a bit of color on.
Right. We've had EM debt in the past. We are looking to find some new managers. I know this is going to prompt lots of calls now in this space. And I do think that we will have probably a couple in this space that we'll settle in on over time. And I think it's really going to depend on level of expertise and accessibility in the markets. This is not something that I think if you've been a fixed income shop and you haven't done EM debt, you wake up and say, let's do this. That's not the easiest thing to pull together and have a good track record in and knowledge base. I think it's very important for managers to have the ability to access boots on the ground, et cetera, in a lot of these markets and understand them. If you're moving down more into frontier, that's even more important. I don't think we'll find ourselves necessarily at this point reaching down that far. But as you watch lots of markets develop here in the future, I think it's important to have a lot of local knowledge.
What's your view on EM equity? Because to me, that's somewhat controversial. It's been something that I've discussed with a number of colleagues, including at events I think that we've been at together. I remember when some time ago, the CFA propaganda was diversification is a free lunch. And if you invest in emerging markets, you get return and you increase your Sharpe and lower risk. And the reality is that was actually the wrong advice. Ex post, that was the wrong advice. Generally, if you had just stayed domestically here with our home country bias in the US on a risk adjusted basis, you would have done far better. And EM equity would have been highly dilutive due to the excessive volatility, massive left tail, the drawdowns. So one of two things now, ex ante, right? Either that will persist or things will be different from here on. My view is I don't have a reason to believe things will be different. But what's your view?
I think the first thing that one has to do when they're looking at a potential specific mandate in EM equity is to first look at your international equity managers and see what they have in EM. What we have found when we do that is that there's a pretty significant sliver that we are seeing our developed market managers in EM. do you want to double down on your exposure by having the sole mandate in EM without actually assessing your true risks? Again, I think this is one of the things that you really have to start on, particularly on EM equity, seeing not just where a company is located, but where also companies have their exposures, where their revenues are coming from. Right? When we look at somebody like Apple, if we want to take, one of an example here, right? How much are they deriving of their income from China or other markets? So when you want to take a look at where your exposures are, it may not just be where a company is domiciled. And when we look at our international, we are seeing that we have a large exposure already to EM. And we're comfortable with that, with the managers that we have and their performance. We ask them still lots of questions about why they're there. So I think that first thing you have to do is make sure you understand what your current exposure is, because it may be greater than you think it is. And then if you want to decide that you like that sector enough and you believe the returns, though I have more of a bias towards how you're looking at it personally at the moment, I'm not proven otherwise yet. I'm comfortable with where we are with our international managers and how they're approaching it and finding opportunities by reaching down a bit. I'm not sure that on a total basis, if we had the sole mandate for EM, that it would produce as positive results as we've had elsewhere.
Shifting gears, what's the biggest challenge you have or have had to achieving your goals?
I think our ability to deploy in private markets, we now have much better resources and access to that. We've been slow to be able to build our exposures in those areas.
Why is that?
Because we were under-resourced, and we did have an advisor that helped us, but it was pretty concentrated in lower to middle market buyout. So we don't have the exposure levels that we would like to achieve. And our deployment plans have been slow paced, which is okay. But I think that our ability to access more opportunities has increased with bringing systems and bringing a senior level person in now to help deploy our mandate in these areas.
Got it. Do you use a consultant or?
We do use Wilshire Associates as a consultant. They particularly help us with some asset allocation work and our book of record for reporting. We have been in the past using in private equity. Now that we have in-house capability, that relationship is ending, but on a positive note.
What's a red flag when the manager is such that you wouldn't invest?
Well, there's a lot of red flags I think that we all see from time to time. I think that gets specific to the particular meeting at any time. I do think overall, though, a lack of transparency is the biggest red flag. And when there is a pushback on information requests, or there is glossing over of terms, then that's a waste of time.
Yeah, I tend to agree. What's a material mistake you've made investing and a lesson learned, ideally?
When I saw your question, I thought about this, and I still have nightmares about this one. It's a very specific one for me personally. It happened to do with a fixed income trade on a treasury. I was at the state of Arizona, and I had traveled to New York, and there was a need for me to sell a treasury bond. And I was at JP Morgan, and it's fairly young, but it was kind of cool to be at JP Morgan and to be sitting on the desk with people and basically having a floor trade. And so I sold US Treasury, the 5s of 06, That was the wrong bond. I was supposed to sell the sixes of '05. I realized it almost instantaneously, too late. It had already gone through. I had to reverse the trade, and I made $97.63 on it. However, it was a terrible mistake to make. I was so embarrassed there. I had to go back to Arizona, explain to my boss, who was trying not to smile as I was pouring my heart out about the mistake that I had made and making $97.63. And he told me, he said, yeah, okay, don't worry, no more arb trading again, however. And so that was a lesson learned about being more diligent, paying attention, not letting the moment get in your way. So yeah, that one still gives me nightmares.
Got it. Earlier, you mentioned the massive inflation, I think, at least in insurance, but I think more broadly that the Drexel's been facing. And obviously, the rate of increase has been decreasing. So we've been in a disinflationary environment, but certainly not deflationary. What's your view on inflation now, if at all, in terms of not from a Drexel spending perspective, but from an investment perspective, and in the context of your portfolio, and how, if at all, that impacts your investing?
Overall, I don't see a lot of factors in the economy that are going to reduce inflation very quickly. I think we still have lots of issues, supply chain wise, demand wise, that inflation will be with us for a while, and how to adjust for this is difficult for many, many companies right now. I think people are feeling this, spending may decline. And while we are looking at earnings and growth, what we see in the stock market, the economy itself isn't showing such exuberance. So I think that this is going to converge over time. And I think we're going to be living with a higher level of inflation. Ultimately, we will see a yield curve that will flatten and steepen to a more normal level, hopefully, and hopefully not at too high rates overall. But I think we've got a lot of work ahead of us before we're going to see the ability to be in a more stable price environment.
I don't want to lead the witness. The geopolitical risk out there, obviously, there are the known knowns, Ukraine, and then there's obviously the situation in the Middle East. And then, of course, there are possible situations like China, Taiwan, and maybe others. Is that something has an impact on your portfolio or investing, or how you position yourself?
We all need to take into account the geopolitical risks that are out there and that can affect markets, both short-term, long-term wise. I think when we are deploying currently and you're more domestically based, I think there's more sense of security. However, the world is integrated, and we do need to take into account how markets are going to react. Again, we're talking about reactions and long-term trends and how things will play out. A lot of unknowns here, I think, that most of us haven't faced before in our lifetimes to this level. So I think you're correct. These are areas that we have to think about, and how conservative do you want to be right now? But again, we're not short-term investors. We're long-term investors, and we understand that there's going to be volatility in the markets over time. So we do as what we can to manage our risks. Understood.
What's a book that you've read either recently or just a favorite? Doesn't have to be finance or investing, could be anything.
A couple of books that I've read lately. One of my favorites that I quote often is Quit by Annie Dukes, the poker player, and how we often have not learned to quit. When is the right time? And I think her chapter, particularly in there, about investment analysts who just can't let go of their thesis when all signs around them are telling them otherwise, I think it's very instructive for our business. but overall as well in life in general, when is it time to say I quit? And I think that's a skill we all need to ensure that we have, so that we have our best outcomes professionally and personally, ultimately. So, because, what is it, quitters never prosper, but I think we need to think about being able to pivot in a way in which we are more agile.
I think that's well said, because if I think back at my investment career, I mean, it reminds me of when I was a PM at Soros, and one of the great things that I think Stan, Scott, and George did was knowing when, effectively the same, when to quit. In other words, if a trade had gone wrong or changed or the thesis no longer held, to just cut it and take your losses and move on. I think that's one of the key attributes that differentiates them and the great investors from most investors who will, rationalize it or stick with it or hope that they get bailed out. So I think that's probably very sound investing advice, as well as advice for anything in life, really.
Yes. Yeah. Hope's not a strategy.
Yeah, exactly.
So,
Though amusingly, I did know a portfolio manager once whose name happened to be Hope, but yeah.
I like that. I'm a history buff too. I love reading history books. I just read To Rescue the Republic, which was about Ulysses S. Grant. It's a fascinating read. I think we forget our US history often. And this was an amazing time, and how we came out of the Civil War, I think, is an amazing story unto itself and a lesson in triumph.
Funny, and yesterday I was on a call with Jamie Dimon, and he was recommending a book on Eisenhower. So that it sounds like I've got two good books to read on those. What advice, if any, do you have for other allocators and investors?
I think that one is to approach things in a positive way. A healthy amount of skepticism should be brought in to the analysis and question assumptions that have led to conclusions. I think it's important to always reassess the inputs you put into a model. Models are biased because we put in the assumptions. So I think we have to check ourselves and check others to make sure that we understand that we are doing all that we can to come up with the best solutions.
Sounds like good advice to me. What didn't we discuss that we should have, or that I should have asked you, or you're discussing with other investors, or that's quite topical? Anything? Again, could be non-investment related if interesting.
Well, let's not talk about what we think is going to happen politically.
Yeah, well, that could be fun, but you're right. We no need. I mean, there's also what I think's going to happen, not necessarily what I want to happen. But yeah, aside from politics, we've generally kept this podcast series out of politics, which for better or for worse.
Yeah, I think it's hard these last few days, and I happen to be sitting in 30 miles south of Milwaukee, so. Needless to say, there's a lot of buzz around here at the moment. Well, you don't have to put any of this into the podcast, obviously. But I think what we've been talking about amongst other allocators is, as I think we've been talking about, mostly the difficulty in having so many managers and so much information thrown at us, that it's the difficulty in discerning efficiently how to call the amount of information that we're getting to get to the funds, the strategies that we want to look at. There's an overwhelming amount of emails, data that we all see every day. And how do we help lead that? How do we help our staffs? How do we help our junior analysts go through and find what is needed, what's an opportunity, and what's a failure? That is becoming more and more challenging as there are more opportunities and actually more data. How do you discern the data?
Well, that's a good segue into something we didn't discuss, which is obviously topical, which is AI and data science, and how, if at all, are you tackling that and looking to grow in that?
So I think we are hopeful that AI will give us more tools to help get us more efficient. I will say that I have a great team and analysts, relatively junior analysts, that are very eager to learn and find information and are thinking about how to assess and how to organize all of this. And I will say our risk analyst in particular, wonderful young woman, when she got to Drexel, she has her CFA, etc., but she went for a graduate certificate in data science at Drexel. And she added to her toolbox. And this is wonderful because it can expand her, just not within investments, but provide her in other tools if she wanted to ultimately change and go a different way. So I do think that having people who are anxious to look into our new technologies and look into opportunity sets is extremely helpful. And I'm very grateful that my team is oriented that way. Again, though, it is difficult to try to get this to be all efficient on a day-to-day basis.
Yeah, absolutely. Okay. Well, on that note, thanks for joining us, Kathy. That was a great discussion and sharing your most valuable asset with us, your time. We hope listeners have a better appreciation for what one of our more thoughtful allocators is thinking about and how we may all benefit from this as investors and allocators. This is your host, Michael Oliver Weinberg, hoping you join us again for our next episode where we speak with another thought leader who will provide insight into improving alpha via innovation. Thank you.
Thank you for joining us on the Improving Alpha, Innovation in Investing, ESG and Technology podcast, presented in partnership with Vidrio Financial and sponsored by Alternatives Watch, thefundmarketer.com and PEVC Tech. Vidrio Financial offers a cutting-edge data management solution that not only collects and cleans your data, but also empowers investment teams to cut through the noise and extract valuable insights for better decision-making in areas such as valuation, risk assessment, and portfolio management. If you're an endowment, foundation, pension, sovereign wealth fund, asset manager, OCIO, or family office facing challenges with your data pipelines, we invite you to connect with us today and explore how Vidrio can seamlessly integrate with your investment team to enhance your data management capabilities. The information covered and posted represents the views and opinions of the guests and does not necessarily represent the views or opinions of Vidrio Financial or our host, Michael Oliver Weinberg. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding investment planning.